Well, good morning, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Schwab. And today, well, we've got a really jam-packed, whoa, I'm getting so much feedback from my mic. It is, okay. Sorry, guys. Okay, so we've got a ton that we want to cover in our 45 minutes together. But I want to have a little bit of a fireside chat today. So in addition to our fireside chat, and what do I mean by that? Well, there are some people that are feeling a little frustrated, because we've been trading these plans now for, I don't know, 6 years together, and they've worked out really well. And so far this year, we've had a lot of examples of trades that haven't worked out as well, haven't we? And so what do you do when you're feeling frustrated and when you're starting to question your trading acumen? So we're going to have a conversation around that. We're going to do some trade management. We're going to start out by placing a couple of new example trades. And so it's kind of business as usual in the trading a smaller account world. We have got Connie Hill with us in the chat today. She's a friend and a fellow coach. She understands everything that we are going to be, talking about, everything on the menu today. If you've got any questions, don't hesitate to chat them in, and between Connie and I, hopefully we'll have answers for you. If you aren't following us on X, consider this your formal invitation. Connie's handle at Connie Hill CS, my handle at Barb Armstrong CS. And Connie posts some really great stuff, especially at the beginning of the day. So you don't want to miss out on that, my friends. It's another complimentary resource and way for us to provide content of interest to you outside of webcasts like this. Okay, so just getting through our important information. We're going to do both stock and option trades today, but know that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform, which is a great place to learn and hone your skills and make sure you understand what you're doing, both if a trade goes for you or against you, in Paper Money before you consider trading in a live account. Past performance doesn't guarantee future success. How we wish it were otherwise. There are some nuances and differences between the Paper Money application and the live accounts. One is that short options will never be assigned early. We're going to look at some short put verticals gone wrong and discuss what might happen if something were assigned early today. So we're going to go have that conversation. Yeah. And we started the year with $25,000. We're down a little bit, but our max position size has remained the same at 5,000. That's 20% of our account value. Now, I teach an after the close class on Thursdays, and we are pretending that we have $1 million that we inherited and we want to invest. And our max position size is 50,000 or 5%. And so it depends on your account size and what you want to do. We wanted to be able to have a stock position or to do a buy right covered call, those kinds of things. And that's why we made the position size that size. There have been years when our most of our account was sitting in cash, and that isn't a recommendation. About 3 years ago or so, when the market was really bearish, we felt that cash was a safer position, and we were doing a lot of short-term bearish trades. And prior to last year, it was our most successful example trading year, was the year the markets were so bearish. But our focus is on a shorter to more intermediate time frame. So we do a lot of short-term trades, both bullish and bearish in this class. Now, I saw in the chat before we got started somebody talking about registering for an event or wondering when the Santa Clara event was going to be open. And all I can say on that is keep checking back. These three are open for registration now. Chicago and Detroit are advanced options 2-day workshops. And we haven't done a lot of those in the last 5 years. So if you, and most of you who are coming to this class and you're the regulars, this might be an appropriate event for you to attend. I will be at the one in Chicago. Kevin will be heading to Scottsdale next week. So if you'd like to meet Kevin Horner, there's your chance. And if you're in Chicago, please come up. It would be great it would be absolutely great to meet you if you are at that event, but register sooner rather than later for these events because they do fill up quickly and we can only cram so many seats into our venues. So we'd hate for you to miss out. Okay. And you can go to schwab.com events and that's how you register. Okay, let's get out to the platform. And one of the things that I have stopped investing time in is reviewing the overall markets. But I mean, when we look at this, we're still up about 15% on the S&P 500 over the last year. At one point, though, we were up 20%. And yesterday we broke this 100, the black line is the 100-day moving average. And it looks like, you know, it's not quite a piercing line yet, but we do have a bullish candle today. And we did break below the 100-day moving average a couple of times over the last year. And it's been a fairly short journey to the downside. And what's going to happen this time? Well, we don't know. But, you know, we do know that, it was just back on February 19th that this market hit a new all-time high. So that we know. So the longer term trend still uptrending. And when we look at the NASDAQ, kind of the same type of story, right? We've had a few dips below the 100-day moving average in the last year. Those have been short-lived. Jury is still out. Yesterday was a very bearish day in the markets, and there was a lot of gnashing of teeth and, frosting of petunias, as we like to say in this class. So we've seen, in spite of the uptrend, a lot of volatility so far this year. We've seen a lot of things getting whipsawed around. And, volatility being over 20, if I draw a 20 line on the chart, got something else here. We haven't very often been above that. When we look at this, if I put this at 20, we haven't spent a whole lot of time above that. It tends to, come up and peak and then come back under the 20 line, but as of right now, we're still above that. Okay, so let's go out and look at something that is still moving bullishly, and this is in the financial sector and, Bank of America. If we come and look at the sectors, just let me compress this, and we look at the financial sector, this too hit a new all-time high back in February, at the beginning of February, and has, by and large been uptrending. This sector has been performing well. So if we're looking at the overall market, if we're looking at, investing in a stock, and in Bank of America, the thought is, and this is just, a 9-month chart. So if we back up a little bit further, when we look at the last year, it went from 34 to 48, which is a pretty nice run to the upside. And then we've seen it kind of consolidate, right? And so some might say, well, could this be like a double top setting up, but it's bounced? And then some might be saying, well, hey, could this be a double bottom? And the answer to both of those is, well, it could be. But the pattern isn't complete. And in order for the pattern to be complete, we'd have to see it either break below this kind of 43-ish range or break above the 47-ish range. But the longer term trend has been more bullish. Okay, so the thought is, and this stock, this candle's risen quite a bit since I first looked at it this morning. But if we look at this and we say, hey, could we buy 100 shares now? And then when it gets up close to this 48-ish level, if it gets up there, sell a covered call. Then, and why wouldn't we just sell the covered call now? Because if we sell it when it's closer to the strike that we want to sell, we'd get more for it. So if I come out here and look at March 21st, if we look at the first, the at the money strike, we get about $1 for that. Where if I look at something that's trading $2 above, so let's say I go up to the 47.50 or the 48, you get 25, 30 cents. So you get, a lot less. And so the idea here is, okay, if we're saying here's our recent low, if we put our stop, say 3% below that, so 43.35, let me bring up my calculator. So we were 43.35 times 0.97. We're risking, we're at 42.04 would be our stop. So we're risking about $3.40 a share times 100 would be $340. And so we can afford to take that much risk. We have said we don't want to risk more than 500. But the intention here is that when it comes up to this 47 level, we're going to add an alert. And we're going to put in a note to say, maybe we make this just 47. If and when it gets up to there, sell a covered call. With either the, and if we're called out, we're cool with that. And if we're not called out and it continues, let's say it comes back down here, then we could buy the call back for less than we paid for it. And then if it comes back up again, sell another one. Okay. And so if we were putting the covered call on today, we're not actually making this 48 our target exit per se. The goal is to sell the call and get paid to sell it, to sell our stocks. Does that make sense? This is the scheming, kind of trade that we're planning for today. So we're just looking at buying 100 shares. And why did we even look at the options? Because we want to be sure that if we actually get the chance to put this scheme into place or this trading strategy into place, does this trade 1 million shares a day or more? Yes. Are the options heavily traded? Like this is a weekly option, and look at, we've got thousands of contracts. The monthly contracts, there's just tons. Okay, like there's someone that bought well, maybe not one trade, but 40,000 contracts were traded today just on the 46.50 strike. So lots of volume, heavily traded. So we're going to today just buy custom with a stop. Okay, our stop is going to be at 42.05. 42.05. Going to make that good till canceled. And then we're going to put this in, you can put it wherever you want. And some might say, well, hey, did you not notice that this stock pays a dividend and maybe we just want to continue to own it? And that's how it may work out. And also that, it has an attractive price earnings ratio, and I'll show you that in a minute. But we're going to put a note in here. Intention is to sell a covered call when it gets, if or when, I like to be, optimistic, if it reaches resistance. Okay. And so we're going to put it in our buy right covered call group, even though technically we're not buying the stock and selling the covered call at the same time. Our intention is to sell a covered call on it. And so that's our note to ourselves. Okay. And then if we come up here, because we're on the trade tab and click this little arrow, we can see it does pay a dividend of 2.29%. Now there's no guarantee that dividends will continue to be paid in the future, first of all. And the second thing is that in a paper money account, dividends are never paid. So, we're looking at earning a pretend dividend for our account. And this has a price earnings ratio of 14, which some people would say would put that in the category of being a value stock. And so many of the high flying growth stocks have kind of had the stuffing knocked out of them. These characteristics on this particular stock or this company, might be making it look more appealing to those who want to move their money to a less volatile spot. Okay, so that's trade number one, Bank of America, check. Okay, now let's go over to the red team. And Biogen has been on that team now for quite some time. Like, this is a 1-year chart. And it has spent very little time in the last year above the 100-day moving average. It has actually, like since July of last year? You'd need binoculars to see the 100-day moving average. It has not even made it above the 30-day moving average except for one day down here. And it was above the 30-day for one whole day. And did that turn out to be a breakout? No, it was a fake out. So this has been really acting as a ceiling, hasn't it? Yeah. Yep. So when we look at this, could we potentially look at a bearish trade and say, hey, this came down to 128.51. Could we buy a put and do a swing trade and say, hey, when it comes down around this 129, I'd like to exit. And, so when we look at this is a trend continuation pattern. And here's our high day. Do we have the requisite? And I haven't got a trading plan created for this yet, but stay tuned. It is on my list for the next week or so to start filling in more of the bearish. We do have I haven't done a swing trade. But we're looking here. I haven't posted a swing trade trading plan, but we're looking for a close below the low of the high day. Did we have that this day? Nope. We had it yesterday though. And today it's, continuing to the downside. Okay, so let's go out and look at that. Just have to get rid of my drawing tool. So we're going to come out actually only 21 days to March. And again, on average, does this trade more than 1 million shares a day? Well, we're early in the day and we're at 350,000. If we look at the April options, we've got hundreds of contracts. So, check. And then the bid-ask spread at 30 cents is less than 10%. So that would meet our trading criteria as well. And so if we look at this 135 strike, it would cost us $460 to $490. And so, and how much could we lose? We could lose all of it. So I'm going to come here to buy, and we're going to buy custom with an OCO bracket. And our target, we don't know exactly what the price of this option will be, but our target, we're going to make both of these exits good till canceled, is if the stock goes at or below 129. Now, if it gets to 130 and looks like it's going to turn around, might we choose to exit? Absolutely. But, maybe you'll be out, golfing or going to Vegas. Somebody said they're going to Vegas, seeing something in the sphere, which would be pretty awesome. I'm going to be in Vegas in June, and that's on my list. I need to look at what's happening there when I'm going to be there. And then for our exit, we're going to make it a 50%. And this is our swing trade exit is, if it loses 50% of its value, the option, it's not either going in the right direction or not going in the right direction quickly enough, and time decay is starting to eat us alive. So confirm and send. And we're going to put this in our long put group. Okay. And this is a swing trade. And, when we look at this, it's currently trading at 139, check. We want to exit if it goes to 129, check. So that's lower. Or if it loses half its value, check. How much could we lose? $490. Now it's saying we could potentially make 13,000. That would be if Biogen went to zero by April 17th. The odds of that happening, very, very low. We're just looking for a base hit here. Okay. Okay, so that's Biogen. Now I wanted to do some trade management because we have a lot of trades on, as is typical. And these iron condors are a combination of a credits, they're two credit spreads. I call it a credit spread sandwich. And so on two of these, we have the entire iron condor on. We've got the short call vertical and the short put vertical. And that's on Dollar Tree and Micron. And both of those are kind of putting along and doing just fine. So if we come out and look at those, Dollar Tree and Micron, and so here's our sandwich. We're expecting it to stay below $77, which it has done now for many, many months. No saying it'll continue, but so far so good. And then our short put vertical is down here at 65. And it looks like the bottom, we're establishing a new bottom around 70, but our strikes are down here. So as long as it stays below 77, above 75, we're in good shape. Micron, our strikes are at 110. So we want it to stay below 110 and above 85. And again, this one expires also March 21st. And so far it's rolling along and doing fine. Now, one of the things that has hurt us is that volatility in the market in general has gone up, which has pushed up volatility, kind of across the board. And we're looking, what we ideally would like to see is volatility to drop. That would help these. Okay. So that's that one. Now we have two others. We have Intel. And on Intel, we talked about this when we put this trade on the other day. So it was up and just falling. It had hit its head on resistance. And so we put the short call vertical leg on and said, hey, when it comes down closer to this 19 strike, if we wanted to place the short put vertical based on visuals on the chart instead of looking just at probabilities, we'd be waiting for it to come down here a little further. And so far, it's not playing nicely. But on our short call vertical, we're up almost 50%. We were up more, because today it's an up day. So it's kind of taken a little bit of the profit. Our unrealized gain has been hit a little bit. Okay. So, and then the last one is Microsoft. And with Microsoft, we were looking to leg in kind of the opposite way. We put a short put vertical on, and then the stock got hit. And so we have, over 3 weeks left. Today we have this big hammer candle, at what has served as a previous support level. In fact, we can extend this, so it's kind of come down into this neighborhood 3 times now. And then when it bounced, it seemed to move up dramatically. So we have 3 weeks for this to, move back up where we aren't compromised. But because this is in the money by both strikes, we've agreed to buy the shares at 405, and we could be assigned. So if that were to happen at this point, what might we do? Well, if we were asked to buy $40,500 worth of Microsoft, we would then immediately turn around and exercise our long put, which gives us the right to sell them at 400. So we would just turn around and sell them, and then we would have locked in our mass loss, but we wouldn't have somebody coming knocking at our door saying, hey, Barb, you don't even have 40,000 in the account. You need to put more money in the account because you just bought $40,000 worth of stock. And we're going to say, yeah, no, we're just going to sell it. Yeah. Okay, so now I want to review. So that's our iron condors. It's interesting because, you know, we only have 3,000 that is sitting in cash at the moment. So we have a lot of stock positions. So we just did this one on Bank of America, but we have two positions where we have a stock, you know, we bought stock and we have a target. And so one of those is AT&T, or was it AT&T just up? Oh no, that's a stock with a dividend. So AT&T, we just bought this. And again, dividends aren't guaranteed to continue to be paid, but it currently pays a dividend of 4.87%. And, you know, and then we also bought Bank of New York Mellon. So, and that, you know, we're just, as long as it continues to go up, we'd be happy to continue to own it and continue to get a, you know, a dividend, a pretend dividend. So this one we bought on this day, and it's been kind of chattering along, but is still basically uptrending. Now, I use this in getting started with technical analysis, this stock as an example, and talked about an example trading plan and how we might use, you know, the 30-day moving average, if it's acting as a support level, as a means of managing our risk and ultimately protecting some of our profit. And we'll use that same strategy ongoing with this stock. I'll clean it up and take these lines off, but that's booking an AT&T. And then we had 3 stocks where we had targets. One is News Corp. And again, you'll notice that many of these stocks are dealing in services as opposed to hard goods, because we're looking for things that are kind of more trade agnostic. And so we bought it on this day. We have a swing target of this previous high of 35, and we did that with the purchase of the stock. And so we're just going to let that continue to percolate. Then we have XEL, you know, which has a pretty modest gain, but, you know, it's 3.45% so far. And we have a target on this one as well. And here's we did a 1 ATR target, I think, with an option that we were out of fairly quickly. This one, our stock target is 73. Now we could, you know, decide to take the money and run on this, but it gapped up today and still seems to be moving pretty bullishly. So we might just let this one go. And then the third one was Autodesk. And Autodesk, we had bought 15 shares. This was our target. And when we look back at this, I believe this was a diagonal resistance breakout that we were looking at. And we bought 15 shares. This was our target. And today it came down and hit our stop. And so we ended up losing on that one. So here was our stop loss order. And when we come and we look at this, we bought 15 shares for $300.23. We ended up out at $277.09. And so how did that pan out? Well, if we take the 323 minus the 27.09, we were down $23.14 a share. Oops. 23.14 times 15 shares. So we were down, oh, I didn't write the number down. I had calculated it ahead of time. 15 times 23.14. $347.14. So although this is not what we were looking for, the intention was to make money, and we may be sad about that. What's the good news? Well, the good news is that we got out, because sometimes when a stock starts falling, it continues to fall, and we decided that we knew when we wanted to get out before we got in. And when we go back and we look at it and we think, was that a valid entry? You can look at that and say, the entry did look valid. Now, the next question you might want to ask yourself is, should we have exited the position sooner? And that's a valid question to ask yourself as well. But it had come down before we got in to this spot, which is why we put our stop below that spot to give it every chance to succeed. And then it came down back to this spot again. And then in one day, it wasn't like it broke support and started flirting with it. Like today, we just had, we were in over earnings. So some might say, if you're doing this shorter term trade, maybe we shouldn't have been in at over earnings. And look at it, totally crushed it on earnings. And yet sometimes this happens and the stock falls anyway. I don't know what the forward guidance was on it, but I think it was successful, even though it was a trade that wasn't profitable, in that we followed our rules. Okay, so that's Autodesk. Now, the one I really wanted to focus on today was the short put verticals. And I had saw that somebody had typed into the chat, Louis is asking if I had Baker, and we may have done an example trade on Baker. I know that we've traded Baker for sure. That I may have used that as an example in another class. I teach every single day, and Monday and Friday we use this account, and then Wednesdays trading price patterns, we use this account also. Yeah, and Sia is saying like NVIDIA is another example where it crushed it on earnings. And this is, we often see this happen with Apple also. It'll have a great earnings report, and the stock will still fall. And you're going, what in the Sam Hill are you looking for? Like, I just work here. That's all I can tell you on that one. But I wanted to look at short put verticals, because short put verticals, we are down $755 on our short put verticals. And that is just frustrating, right? It's just frustrating. And let's have a look at these. So we've got Starbucks where we're up 60%. And then we have a couple that we're getting creamed on. So Starbucks is just kind of rolling along and doing its thing. We want it to stay above 110. So far, so good. Now, this expires next week. So we're going to look at this one again on Monday. And if it's not at the 80% target we put in, we may just close it out anyway. And so we could close it out now. But this is the thought that might be going through some traders' heads, including mine, is that, hey, we have the weekend coming up. Yay. And time decay continues to work in our favor. So, if it just kind of keeps on keeping on, then that time decay may tip us over, what we're aiming for. At least that's the thought. And so that kind of would apply to Starbucks and Triple M, 3M. Where we placed this trade, just about a week ago, and we want it to stay above that 145. So, of course, as soon as we place the trade, 2 down days comes down to our strike. But now it's kind of taken off. And again, we could take the money and run, right? But we've got 2 days of kind of free time decay. Now, it won't feel very free if the market tanks again on Monday. But this is the kind of the thought process that a trader has to go through, and that someone who is, trading these strategies, this is the yin and the yang, right? Okay, so that's those two. Now we have one on Netflix. So, and here's Netflix. So we just put this one on Wednesday in our trading price pattern class. And it's just come down and it's just sitting on that ledge. And today, you know, if you're new to candle patterns, you can go back and watch the trading a smaller account, or sorry, getting started with technical analysis. We talked about candlestick patterns, but this is a Harami pattern, which is considered bullish at when it occurs at a support level or potentially bullish. You know, so, you know, could this drop again Monday? It could. And might we reconsider whether we want to continue to be in the trade? We might. But so far, we just put this on. This support level appears to be holding. So we'll just see how that plays out. Now, how about Meta? So Meta, we put this one on here. This expires March 21st. So this is, you know, we went out a long ways on this one. So I'm not quite sure why we picked such a long expiration, but now we might be a little grateful for it in that this is underwater. So it's at 660. It's through both our strikes. And the risk of assignment goes up when it is, you know, what we call in the money. But, you know, might this be finding a support level kind of around here? Well, it might. Now, there's no guarantee, but we have 3 weeks for it to decide to get its rear end in gear and move back up where we want it. And so this is sometimes where we need to be patient. Okay, so that's Netflix. Okay, how about Meta? We have one on Meta also. We have quite a few of these babies on. So, okay, so this is Meta. Okay. How about BD? That's one. Okay, let me come back and look at my list. Oh, BA. You know, I kind of have a love-hate relationship with this stock. Somebody said, I hate trading this because I always get, you know, it never goes my way. And I'm not going to say that because we did place an example trade. And you know why? Well, if we come out and look, we had this big inverted head and shoulders. It broke out, came back and retested again. And I think we put it on this day. But, you know, it's now below our strikes. And wouldn't that just kind of frost you? But you know what? It's been in this area for a while. And we had a Harami pattern yesterday. I don't know if you can call this a 2-day-old Harami, but you know, it seems to have found a support level here. You know, and you might say, why didn't you put the strikes down there? Well, yeah, that would have been a good idea, wouldn't it? You know, but we didn't. They're up here. And so we've got some time, and so we're just going to be patient. Okay? Okay. So that is BA. Now, how about the Goog? Because we did one on Google. Oh. Okay, now this is like seriously ugly, my friends. And you know, when we place this trade, so again, when we look at the logic of it, when you go back and do a postmortem, you know, we had, just let me get my drawing tool. So we had this cup and handle, right? Which is considered to be a bullish pattern. And, you know, we went from 148 to 181. So like just I'm ballparking here, about a range of about 30. And we're saying, well, you know, we might expect it to go up to, you know, about 210. And look at that. It came right up to 207. But it, you know, it broke out, kind of retested and, you know, kind of was going a bit sideways, right? And then it came down. So on this day, we have this Harami pattern, which is considered a bullish pattern at a support level. This sure looked like a support level. And then what does it do? Well, it confounds us. So now, March 7th, we do have a candle pattern saying, hey, this could turn around. You know, this hammer is saying, like, I think the sellers and the buyers, they've about duked it out, and maybe the buyers are going to come in and, and again, service. But we have only 7 days, like next Friday it expires, and we're pretty deep in the money. And we're at risk for assignment. Now we know what we do. If the short strike was assigned at 185, we don't have enough cash in the account to buy 18,500 worth of stock. We'd immediately turn around and exercise our right with the long put to sell at 180, which would guarantee us or fix us, at a max loss. And so if we're saying, well, that doesn't look so appealing. Now, one of the things that's fascinating to me, we wanted it to stay above 185. It's currently trading at 168. So you think, this is what I thought, well, we must be at max loss. But, it's currently, we have a $5 wide strike. Well, we're only 10 cents away from max loss. We're at 487. So if we close this trade out now, we're locking in, we're only 1250 away from a max loss. So given that we have this candle, we might just say, you know what if it has a big up day? Like, this stock has been known to have big up days, right? Like here, here it gapped up, and maybe exit this on Monday for, a little less of a max loss. Now, if it continues to the downside, we'd end up with a max loss. So Sia is saying, how about rolling it? So some traders believe in kicking losing trades down the road. I am not one of them. And some traders feel strongly that if you have a losing trade, just take your lumps and exit. And the thought being, if you wouldn't place that trade today, then why would you consider, because when you're rolling a trade, you're basically buying back the trade or closing out the trade you had and opening a new trade. If you weren't already in this losing sucker, would you place that new trade where you're placing it? And if the answer is no, then there are those that would say, okay, I'm not doing this. Okay. So, and this is waffling back and forth, but this hammer pattern is saying, we may have found a support level here, but this is one where we don't want to risk being assigned. Okay. And so sometimes, with short verticals, these can go wrong, and it behooves us to not stick our head in the sand and pretend we aren't seeing it, but to just admit that we made a mistake. Okay. Okay. And so if you want to see an example, and I saw something in the chat. So if you do want to see an example of closing it out, you would just come in here, and this is how you would do it. You would come down to Google, and you would say, this is I want the put. Okay. Here, instead of 75 cents, I'm going to cancel and replace it. And I'd have to pay $4.98 to buy it back. Just close it out. Confirm and send. Now we're going to wait until Monday on that. But we'll come back to that one on Monday. Okay, guys, well, we are out of time. So what did we do? We, faced the music and looked at the trades that have gone wrong. And what I encourage you to do is continue to follow your plan. But can you modify your plan? Well, one, you could say, hey, my target on these trades on a long call vertical or a long put vertical is typically 50%. If those trades I'm finding I'm up 30 or 40% and then they're going against me, could we modify the plan and say, I'm going to get out when I've got a 25% gain? We can. Okay, now just as we wrap, If you haven't hit the like button, hitting like just helps move things up in the algorithm so that more people can find this content. I'm just trying to bring us back to the PowerPoint. Yeah, so if you'd hit the like button, you could be doing a favor for a random stranger. It also lets Connie and I know that you found this content valuable, and we appreciate that. So hit the like button. If you haven't already subscribed, please hit the subscribe button. We don't have a survey in the chat today, but as we close, if you haven't followed us on X already, please consider doing that. Connie Hill CS, Barb Armstrong CS. Have a really awesome weekend. Get out and hug someone you love. And if you're going to one of the upcoming live events, I will look forward to seeing you there. Take care, everyone. Bye for now.